Look, at 2:40 in the morning Eastern Time, I watched silver touch 95.77. Now it's mid-morning, the screen says 94.20, and every major bullion dealer I've checked has gone dark on their ask prices. Not temporarily out of stock. Dark. No quote at all. I've been trading physical silver and mining equities for over a decade, and I've never seen this specific pattern, where the digital price ticks down while the physical market just stops quoting. The mainstream narrative right now is calling this a speculative bubble, a retail frenzy driven by social media hype. They want you to look at this morning's 40 basis point pullback and think the party's over, close the tab, move on. But here's what they're not telling you. While you're watching that ticker bounce around $94, the actual plumbing underneath the global silver market is coming apart. The banks and the exchanges want you focused on that screen price. They are terrified you'll look at the 8% lease rates, because that's where the real blood is. We're not in a normal bull market. This is a structural squeeze happening in real time. A pincer move between China's export blockade that just erased 7% of global supply and a total hemorrhaging of COMEX registered vaults. This isn't paper traders pushing futures contracts around. This is industrial users scrambling for physical metal while the exchanges pretend everything is fine. What I am going to do here is break down the China licensing shock that blindsided the market on January 1st. Explain exactly what these 8% lease rates mean and why they're a death sentence for dealers who sold short. And then I'll share my exact personal positioning plan for what happens when we test $100, because we're going to test it. The only question is whether it holds or whether we see the most violent correction of the decade. But before we get into the charts and the vault data, you need to understand that 7% of the world's silver supply vanished overnight. Not because of a mine collapse, not because of a natural disaster, but because the Chinese government decided to flip a switch. Let me give you the numbers I was looking at a few hours ago. Spot silver, 94.20. The dollar index softening to 99.08. And the gold-silver ratio, which has been the most reliable indicator of silver's relative strength, just collapsed to 51-1. For context, in 2021, when silver hit 30, that ratio was sitting at 65-1. We're in uncharted territory here. Now contrast that screen price with what's actually happening in the COMEX warehouses. 33 million ounces pulled out in 2 weeks. Registered stocks, the metal that's actually available for delivery against futures contracts, sitting at 128 million ounces. That sounds like a lot until you do the math on the current withdrawal rate. At this pace, those vaults hit zero by April. Here's the China factor, and this is where most coverage gets it wrong because they're treating it like a rumor or a maybe it will happen policy shift. On January 1st, 2026, the Chinese government implemented a mandatory export licensing system for antimony, gallium, germanium, and silver. Not a tariff, not a quota suggestion, a hard licensing gate on 10% of global silver supply. If you're a Chinese producer and you want to export silver, you now need explicit government approval for every shipment. And from what I'm seeing in the trade data, those approvals are moving at a glacial pace when they're moving at all. Meanwhile, you've got treasury yields jumping 2% on political friction. Normally, that would crush silver, strong dollar rising real yields. That's the traditional death combo for precious metals. Except silver isn't responding, it's decoupling. And that decoupling is telling you that something structural has changed in this market. Stop for a second and look at the COMEX inventory chart. I'm not talking about a slope, I'm talking about a cliff. From June 2025 to now, we've gone from 210 million ounces in registered stocks to 128. That's a 39% drawdown in 7 months, and the pace is accelerating. But the inventory drain is only the symptom. The lease rate is the disease. Let's pull this apart, because if you don't understand lease rates, you don't understand what's actually happening right now. A silver lease rate is the interest rate charged to borrow physical metal. Think of it like this. If you're a dealer and you sold silver you don't have, maybe you sold futures contracts or you took customer orders you can't fill immediately, you need to borrow physical metal to stay solvent until you can source it. Normally, that lease rate sits around 0.5%. It's cheap insurance. No big deal. Right now, silver lease rates are sitting at 8%. That's 16 times normal. And they've been above 6% for 3 straight weeks. Here's why that matters. When lease rates explode like this, it means the people who actually own physical silver are refusing to lend it out. They don't believe they're getting it back. It's the ultimate signal of backwardation, when the spot price is higher than the future price, because people value the physical metal in their hand more than a promise of delivery later. Let me give you an analogy. Imagine you walk into a car rental place and they want to charge you $1,000 a day for a Toyota Corolla. Not because the Corolla suddenly became a Ferrari, but because it's the only car left in a city where everyone else is walking. That price isn't reflecting the value of the car. It's reflecting the desperation of the situation. That's what 8% lease rates are screaming at you. Dealers who sold short, who promised delivery, are now paying 16 times the normal rate just to stay solvent for another 30 days. Every day that lease rate stays elevated, they're bleeding. And when the cost to borrow metal exceeds the cost to just buy it outright and eat the loss, that's when the paper exchanges are minutes away from a default. Let's do the math, because numbers don't lie even when the narrative does. China just cut 10% of global supply with their licensing system. That's roughly 80 million ounces a year, or 6.7 million ounces a month, that just got locked behind a bureaucratic wall. Meanwhile, COMEX registered stocks are sitting at 128 million ounces, and we're draining them at roughly 16 to 17 million ounces per month based on the last 2 months of data. Conservative scenario, if the withdrawal rate holds steady and China's restrictions stay in place, the COMEX vaults hit 0 available silver for delivery by mid-April. That's 11 weeks from now. Now let's stress test that. There's a rumor circulating, and I can't confirm this, but it's coming from 3 separate sources I trust, that East Asian electronics manufacturers are bypassing the COMEX entirely and going directly to miners offering premiums of 10 to 15% over spot. If that's true, if the industrial users are pulling an end run around the paper exchanges and buying directly from producers, then the COMEX price becomes irrelevant. It becomes a ghost price that nobody's actually transacting at. Here's the gap that nobody's talking about. The current $94 screen price doesn't account for the 8% borrowing cost. If you're a dealer and you need to lease silver to fulfill a contract, your true cost basis isn't $94. It's $94 plus the 8% annual lease rate prorated over your borrowing period. For a 30-day lease, that's an extra 62 cents per ounce. Doesn't sound like much until you multiply it across a million ounce position. Then it's $620,000 just in borrowing costs for 1 month. The real silver, the stuff that's actually changing hands in physical form, is already trading over $100 in the shadows. The paper price is lagging reality by at least 6%, and that spread is widening. So let's recap where we are. 8% lease rates, a 51-to-1 gold-silver ratio. 33 million ounces drained from COMEX in 2 weeks. This isn't a rally where people are buying because the chart looks good. This is an evacuation where industrial users are hoarding because they can't afford a supply disruption. But there are smart people betting against this, and they've got some very dangerous evidence on their side. The strongest bear case right now is industrial thrifting. Lone Guy Green Energy, one of the largest solar cell manufacturers on the planet, just announced they're accelerating their transition to copper-based TOPCon cells, specifically to reduce silver exposure. They're not alone. The entire solar industry has been working on silver reduction tech for 3 years, and if they successfully cut their silver usage by even 30%, that's a demand crater of roughly 50 million ounces a year. Then you've got the Shanghai Gold Exchange hiking margins by 20%. For anyone who doesn't trade futures, let me explain what a margin hike does. It forces small speculators to either post more cash collateral or close their positions. It's a cooling mechanism. The exchange raises the stakes, the weak hands fold, and the price artificially compresses. We saw this exact move in 2011 when silver hit $49. The CME hiked margins 5 times in 9 days, and silver collapsed to 35 within a week. There's also this myth floating around that silver is just following gold, that there's no independent story here. Gold is up, sure, but gold is up 28% year over year. Silver is up 95% year over year. That's not correlation. That's decoupling. Silver is moving on its own fundamental story, and that story is industrial demand colliding with a supply shock. Now, the skeptics are right about the long term. If the solar industry successfully pivots away from silver over the next 2 years, the structural demand floor does drop. But here's the problem with that bear case. Technology transitions take time. Longi's new copper cells aren't hitting mass production until Q2 2026 at the earliest. The squeeze is happening this week, right now. The skeptics are positioning for a future reality, while the present reality is that industrial users can't get metal. In the short term, and by short term I mean the next 4 to 8 weeks, the bears are about to get liquidated, because the physical shortage is immediate and the paper market can't wish it away with margin hikes and narratives. So what happens next? Here's what I'm watching. First, the CME. If silver pushes above 96 and holds for 2 sessions, I expect another margin hike. They'll frame it as market stability and risk management, but what it really is the exchange protecting the clearinghouses from a delivery default. Watch for media narratives to shift from silver rally to silver market manipulation by retail or coordinated pump by social media. That's the playbook. They did it with GameStop, they did it with nickel in 2022, and they'll do it here. Second, London. There's a rumor, again, unconfirmed but persistent, that a major LBMA vault failed to deliver 5,000-ounce bars to a counterparty last week. If that gets confirmed, if we see any kind of force majeure declaration out of London, the LBMA is finished as a credible physical exchange. All trust evaporates overnight, and you'll see a mass exodus of capital into fully allocated storage or directly into mining equities. Third, the U.S. Treasury. China's licensing move is a strategic commodity play, and the U.S. is not going to sit idle if they believe silver is being weaponized. Watch for potential reclassification of silver as a critical mineral or expedited permitting for domestic mining projects. That takes months to implement, but the announcement alone would move the market. Here's a pattern interrupt for you. Pull up the volume data on the March 2026 futures contracts. The open interest on those contracts is sitting at 163,000 contracts. That's 815 million ounces of notional silver. The entire COMEX registered inventory is 128 million ounces. The ratio of paper claims to physical metal is 6.4 to 1. This isn't retail speculation. This is institutional panic manifesting as a scramble for futures exposure because the physical market is inaccessible. We are approaching the $100 psychological level, and this is where it gets interesting. Because $100 is both the most dangerous top and the breakout of the decade, depending on how the next 72 hours play out. Let me tell you exactly what I'm doing. I'm not looking for price targets on a chart. I'm looking for structural triggers that tell me whether this squeeze is resolving or escalating. First trigger, the $100 test. If silver touches 100 and I see a shooting star candle, long upper wick, small body, high volume, I'm personally trimming 10% of my physical position. Not because I think the bull market is over, but because I want to pull my initial capital out of the fire. I've been in this trade since $78, and I'm not going to let a violent correction wipe out 3 years of gains because I got greedy at the top tick. Second trigger, lease rates. If I see lease rates drop back below 2% while the price is still above $90, that tells me the physical squeeze is easing. It means metal is starting to flow again, that the supply panic is calming down. In that scenario, I'm tightening stop losses on my mining stocks because the explosive upside is probably behind us. Third trigger, support test. If we get a violent correction back to $84, that was the December high, and it holds as support, I'm looking to add to my mining equity exposure. That would confirm 84 as the new floor, and it would set up a much healthier base for the next leg higher. I'd rather buy a successful retest than chase a parabolic move. Fourth trigger, exchange intervention. If the CME hikes margins above 30%, I'm sitting on my hands. I refuse to be shaken out by paper market rule changes. That's a volatility trap designed to force liquidations, and I'm not playing that game. I'll wait for the dust to settle and reassess once the leverage gets flushed out. Here's my hands-off rule, and this is critical. I do not chase breakouts above $100. If silver gaps up to 105 on a Sunday night when the markets reopen, I'm not buying that gap. That's emotion, not strategy. I'll wait for a pullback, or I'll miss the move entirely, and I'm fine with that. The worst trades I've ever made have been chasing parabolic moves because I was afraid of missing out. The next 48 hours are going to decide whether my silver position is worth $100 an ounce or $150. And I don't know which one it's going to be, but I know what I'm watching, and I know what I'm doing if I see those triggers. Let's bring this home. China choked off 7% of global supply with a licensing system that nobody saw coming. The COMEX is bleeding 16 to 17 million ounces a month, while registered stocks sit at 128 million. And lease rates at 8% are telling you that the people who own physical metal are refusing to lend it because they don't believe they're getting it back. The $94 screen price is a lie. The real market, the one where physical metal actually changes hands, is already over $100. The paper market is just catching up, and when it does, the move is going to be violent. This is the end of a decade of price suppression. It's not just a trade, it's the physical world reasserting dominance over the digital one. The COMEX and the LBMA have been running a fractional reserve system on industrial silver, and that system is breaking down in real time. Now, if you want to understand why this inventory drain is happening faster than anyone predicted, why the vaults are emptying at this specific rate, go back and watch my previous deep dive on the LBMA vaulting system. You need to see the structural why to survive the tactical how, because this isn't about calling a top or catching a bottom. It's about understanding the mechanism so you don't get shaken out when the exchanges hike margins or when the media starts screaming bubble, beat bubble. The math is simple. The vaults are draining, the lease rates are screaming, and the industrial users are hoarding. Everything else is noise. This is the moment. Not the moment to panic, not the moment to get euphoric. The moment to execute your plan, stick to your triggers, and let the market come to you. Because if you chase this, you're going to get hurt. But if you position intelligently and respect the volatility, this could be the trade that defines the next decade of your portfolio. I'll see you in the next one when we know whether 100 held or whether we're back at 84 rebuilding. Until then, stay sharp.